New grandpa, too. Is that right, Barry? Congrats.
That is right. Thank you.
Okay, huge congrats. All right. So what kind of world is this child walking into? You don't think a recession is imminent?
I don't. And the thing that occurred to me around that, as you and Steve were talking about recession, is that I don't know whether Dave Zervos is part of his survey as well, but I think we're the only two I've heard regularly talking about the difference between a typical recession like the last three, which were credit driven, where both nominal and real growth contracted, to one like the ones we had in the 70s, where nominal growth kept rising and real growth contracted. In those cases, the earnings downside is much less significant than it is when you have bank-fueled credit crunches. So the other thing that occurred to me as you and Steve were talking was, you were talking a lot about potential government support. Well, there's already excessive government support. And I would argue that what really occurred in the 70s, the reason that inflation was truly intractable during that period was not because of the Fed's stop-start. It was because the fiscal impulse just continued apace. The fourth paper at Jackson Hole this year was fantastic. It was titled Inflation as a Fiscal Limit. And it argued that the real cause, the root cause of inflation in the 70s was that fiscal impulse, which is also prevalent today. So unless we're going to get a big contraction in government spending and those transfer payments that have been surging, but really surged through the pandemic, it's unlikely that consumer spending is going to fall off a cliff. Capital spending looks really robust. The party that's most hurt by the inverted yield curve right now is the government and the Fed, not so much the private sector.
Well, literally the payouts that they have to, make. But let me ask you then, when you look at something, and I know you are a student of financial markets history, so when you look at the track record of the ones versus the tens, and you say the last 11 times they've inverted, 10 of those times ended in recession, and the 11th with sharp rate cuts. Now we're in episode 12, okay? Is this time going to be different?
Well, there's a couple of things to think about with respect to that. One is I'm very skeptical of anything where the benchmark rate, the longer term rate, is the belly of the curve. So 5 and 10-year part of the curve. And that's because the Fed's balance sheet is still exerting what the Kansas City Fed estimates to be 160 basis points of downward pressure on that part of the curve.
Wow, yeah.
So a lot of that inversion of 2s, 10s or 3-month 10s is because of the Fed's balance sheet and the passive approach they're taking to unwind it. Now, the 5s bonds or 5s 30s inverting, or that near-term forward spread inverting, is a little bit more of a true signal. And there, yes, that signal is on the precipice of saying we could have a recession. On the other hand, credit spread models have a really good track record as well. And the probability from credit spread models of us going into recession is more like 25%.
So